Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden agendas and surprising moves behind corporate filings. Today, we're diving into a filing that might just be a game changer for SHF Holdings, Inc., and something you definitely want to understand. Before we dive in, if you like uncovering the real story behind company news, make sure to subscribe, and for more real-time insights and discussions, join our Discord community linked in the description below. So, what is the big news from SHF Holdings, Inc., formerly known as SHF Holdings Incorporated? Well, they just filed a Form 8K, which is basically a report for major corporate events that aren't part of the regular financial reporting cycle. And this one is packed with some interesting developments detailing a significant agreement that could reshape their future. At its core, this filing is about a crucial deal SHF Holdings, Inc. struck on the 17th of September 2025. They entered into a common stock purchase agreement with Creo Investments LLC. Think of this as a deal where Creo is agreeing to potentially buy a lot of SHF's stock under specific conditions. Let us break down what this agreement actually means. SHF Holdings, Inc. can sell up to $150 million worth of its Class A common stock to Creo. Now, there is a twist here, a bit like a protective clause. Initially, unless they get approval from their shareholders, they can only sell a maximum of 582,899 shares. This number is important because it represents 19.99% of the shares they had before signing this deal. This is a common rule to prevent companies from issuing too many new shares without a vote from their existing owners, which could dilute their ownership stake. However, they can sell more shares outside this 19.99% limit if those sales are considered at-market transactions. The agreement also has a built-in flexibility. HF Holdings, Inc. and Creo can agree to increase the total amount Creo is committed to invest, potentially up to a staggering $500 million. If they do decide to increase this commitment for every additional $100 million that Creo agrees to invest, SHF Holdings, Inc. will issue Creo extra shares valued at 0.75% of that increased commitment. These extra shares are called Creo commitment shares, and they are issued within 1 business day of the increased commitment. Beyond just buying stock, there is also a registration rights agreement. This means that HF Holdings, Inc. has promised to file paperwork with the Securities and Exchange Commission, or the SEC, so that the shares Creo buys can be resolved by Creo. This is pretty standard for these types of deals, ensuring that the investor can eventually liquidate their investment if they choose to. Here is where it gets really interesting for SHF Holdings. Inc. they have the right, but not the obligation, to tell Creo to buy shares at a discount. This can happen on any business day where their stock price is at least $1. And if certain conditions are met, the purchase price is determined by something called the VWAP purchase price. That means Creo will buy the shares at 90% of either the lowest sale price that day or the volume. Weighted average price over a specific period. This is essentially a way for HF Holdings, Inc. to raise capital regularly, but at a price that ensures Creo gets a good deal and is incentivized to keep participating. It is like having a standing order for stock, but at a preferred price. This agreement is set to last for quite some time, up to 36 months. Unless it ends sooner, the agreement can terminate if Creo buys the maximum allowed, if the stock stops trading on a major exchange, or in the event of bankruptcy. So, there is a clear timeline and defined exit points for both parties. Now, as for what SHF Holdings, Inc. gets out of this beyond the potential cash infusions, is the Creo commitment shares. The company will issue $1 million worth of a newly designated series of their preferred stock to Creo as a way to thank them for their commitment. This is essentially a sweetener for Creo, a form of compensation for agreeing to be there to buy stock when HF Holdings, Inc. needs it. The net proceeds expected from these sales will really depend on how often SHF Holdings, Inc. decides to sell shares and at what prices. The company figures any money they get from these sales will go towards working capital and general business operations. Management seems to think having this flexibility is a good thing, allowing them to raise cash when needed, depending on how the market is behaving. Looking at the bigger picture here, this kind of agreement, often called a variable prepaid forward or a subscription line, can be a lifeline for companies that need consistent access to capital without having to go through the full IPO or secondary offering process every time. It allows them to tap into the market on their own terms. However, it also means that their stock price can be influenced by the selling pressure from these ongoing sales, especially if they at a discount. The 19.99% limit and the need for shareholder approval to exceed it is a key point to watch. If they need to raise more money and can T get shareholder approval to go above that threshold, it could limit their options. The VWAP purchase price, especially at 90% of the VWAP, means that Creo is getting shares at a discount, so the actual dilution to existing shareholders could be significant over time. The company's ability to secure shareholder approval for larger issuances will be critical for its long-term growth strategy. In summary, SHF Holdings, Inc. has secured a flexible, albeit potentially dilutive, funding mechanism with this agreement. It provides them with capital to manage their operations and pursue growth, but shareholders should be aware of the potential for increased share count and the impact on stock price. The company's strategy here is clear: maintain operational flexibility and access to funds, but it comes at the cost of creating a large shareholder that might be selling into the market. So, what is my take on this? On the one hand, SHF Holdings Inc. is showing smart financial agility by setting up this line of credit with Creo Investments LLC. This gives them the power to raise funds when they see opportunities or face unexpected needs, especially when their stock is valued at a reasonable level. The safety net of the 19.99% limit and the need for shareholder buy-in to go beyond it shows awareness of existing shareholder concerns about dilution, which is a good sign. However, the structure of buying shares at a discount, the VWAP purchase price, means that for every $SHF Holdings, Inc. raises, existing shareholders might see their stake S value decrease. This is a common trade. Offer flexible capital, but it is one that investors need to keep a close eye on. The real test will be whether SHF Holdings can effectively deploy the capital raised through this agreement to drive growth and ultimately increase shareholder value, or if the ongoing share sales will create too much of a drag on the stock. Alright, that is our breakdown of SHF Holdings Inc.'s latest filing. What is your take on this stock purchase agreement and what it signals for the company? Future, do you think it is a smart move or a risky one? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And don't forget to subscribe for more deep dives into corporate finance. And for even more real-time discussions and insights, check out our Discord community linked in the description. Thanks for watching, see you next time.